Disclaimer.
Something unprecedented happened in the first week of December 2024, and most Americans have no idea it occurred. Over just 4 trading days, institutional buyers drained 47.6 million ounces of registered silver from COMEX vaults. That's roughly 60% of the available deliverable supply, vanishing in less than a week. To put this in perspective, imagine if 60% of all gasoline in your state's storage tanks suddenly disappeared in 4 days. You'd notice the panic at the pump immediately, right? But this happened in our financial markets, and the mainstream financial press barely mentioned it. Here's what should grab our attention about those numbers. COMEX, the world's primary silver futures exchange based in New York, maintains 2 categories of silver in its vaults. Eligible silver, which can potentially be delivered but hasn't been allocated yet, and registered silver, which is specifically earmarked and ready for immediate delivery to contract holders who demand physical metal. When registered inventory drops this dramatically, this quickly, we're watching something that looks disturbingly similar to a bank run, except instead of depositors lining up for cash, institutional players are demanding actual metal instead of paper promises. Think about what this withdrawal rate means for anyone holding silver contracts or planning to buy physical metal in coming weeks. According to CME Group data, registered silver at COMEX stood at roughly 79 million ounces at the start of December. 4 days later, that number had collapsed to approximately 31 million ounces. Some of this metal was reclassified as eligible inventory, but most of it physically left the vaults, transferred to other locations, shipped overseas, or delivered to entities that wanted possession rather than exposure. This kind of velocity and physical demand doesn't happen during normal market conditions. You might be wondering why sophisticated institutions would suddenly prefer holding actual metal over convenient paper contracts that have worked perfectly fine for decades. The answer connects to a ratio that professional money managers watch obsessively, but regular investors rarely understand: the gold to silver price ratio. Right now, this ratio has crashed below 60 for the first time since 2011. And that breakdown is triggering automatic rebalancing across pension funds, endowments, and institutional portfolios worth trillions of dollars. Let me explain how this ratio actually works in the real world of portfolio management. When gold trades at $2,400 per ounce and silver trades at $40 per ounce, the ratio sits at 60 to 1, meaning it takes 60 ounces of silver to equal the value of 1 ounce of gold. Professional commodity managers use what's called the 80-50 rule. When the ratio climbs above 80, they sell gold and buy silver because silver has become historically cheap relative to gold. When the ratio drops below 50, they do the opposite because silver has become historically expensive. But here's the critical detail most people miss. The zone between 50 and 65 is where the real action happens, because that's when institutional buyers who missed the first move start panicking about being left behind. We haven't seen this ratio drop below 60 since the aftermath of the 2011 silver peak, when silver briefly touched $49 per ounce before crashing spectacularly. That collapse left deep scars in institutional memory, and many professional managers swore they'd never chase silver near those levels again. But this time feels different because the fundamental supply situation has deteriorated in ways that didn't exist in 2011. According to the Silver Institute's latest World Silver Survey, we're facing the 4th consecutive year of structural deficits, global demand exceeding mine supply by hundreds of millions of ounces annually. Someone has to make up that shortfall, and increasingly, that someone is pulling from above-ground inventories that were supposed to serve as market buffers. Now here's where the timeline becomes critical for anyone considering silver exposure. China, which controls roughly 60% of global refined silver production through its processing facilities, has announced export restrictions beginning January 2026. You read that date correctly. We have essentially 1 month before the world's dominant supplier implements controls that will fundamentally fracture the global supply chain. This isn't speculation or rumor. According to official statements from China's Ministry of Commerce, new licensing requirements for silver exports take effect in January as part of broader national resource security initiatives. What does this export ban actually mean for American buyers, pension funds, and anyone who needs silver for industrial or investment purposes? Consider that China exported approximately 2,400 metric tons of refined silver to Western markets in 2023 alone. That's roughly 77 million ounces of supply that suddenly requires government approval to leave Chinese borders. Some of this metal will still flow to approved buyers under strategic agreements, but the days of frictionless spot market purchases are ending. Japan learned this lesson with rare earth elements in 2010, and European manufacturers are learning it right now with battery materials. Our turn is coming in approximately 30 days. The institutional money managers draining COMEX vaults aren't conspiracy theorists or gold bugs preparing for apocalypse. They're fiduciaries responsible for managing retirement savings, pension obligations, and endowment assets who've done the basic math. If Chinese supply becomes restricted right as the gold-silver ratio compresses to levels that trigger rebalancing mandates, and if COMEX registered inventories continue depleting at anything close to this December rate, then someone is going to be left holding contracts they can't convert to physical metal. That someone won't be the sophisticated players emptying the vaults today. Have you checked the premiums on physical silver coins or bars recently? Not the spot price you see quoted on financial websites, but the actual price you'd pay to take possession of metal from a dealer. According to data from major bullion dealers, premiums on American silver eagles, one of the most liquid forms of physical silver, have climbed to 6-digit weight over spot price, representing roughly a 15-20% markup from where premiums sat just 6 months ago. Compare this to gold premiums, which remain relatively stable at 3-4% over spot. This premium divergence tells us that physical silver markets are already experiencing stress that has not fully translated to futures prices yet. This brings us to a question that should concern anyone with retirement savings allocated to precious metals or commodity funds. What happens when paper markets and physical markets start pricing silver differently? We've seen hints of this bifurcation already. Shanghai spot silver traded at a 15% premium to London spot prices during certain hours in November, according to Bloomberg terminal data. That kind of geographic arbitrage gap shouldn't exist in functioning markets with adequate deliverable supply. It's the financial equivalent of bottled water costing $1 in one grocery store and $1.15 at the store across the street. Theoretically impossible if anyone can freely move inventory between locations. The Federal Reserve's recent actions suggest they're aware of emerging stress in precious metals derivative markets, even if they're not publicly discussing it. Between December 18th and December 31st, the Fed conducted emergency reserve management purchases totaling $40 billion, while simultaneously expanding year-end repo operations beyond typical seasonal patterns. The official explanation focuses on routine liquidity provision and treasury market functioning. But dig into the details of which financial institutions access these facilities, and you'll find several banks with significant commodity derivatives exposure, the same banks that happen to hold major short positions in silver futures. You do not need to be a financial conspiracy theorist to recognize that something structural is breaking in silver markets. The evidence sits right there in the data: vanishing vault inventories, compressing price ratios, looming supply restrictions, and central bank liquidity operations, all converging in the same 4-week window. Pension funds are quietly repositioning. Institutional buyers are demanding physical delivery. And we're watching it happen in real time during the typically quiet year-end period when most traders are checking out mentally until January. January 2nd marks the beginning of a new quarter, which means portfolio rebalancing mandates kick in for funds that adjust positions every 90 days. January also begins China's export licensing system for silver, which means the last month of unrestricted buying concludes. And January happens to be traditionally the highest delivery month for COMEX silver contracts, as investors who bought during the previous year decide whether to roll their positions forward or stand for delivery. All three catalysts hitting simultaneously while registered inventories sit 60% below normal levels. This is the setup that creates price discontinuities. What comes next isn't a prediction or a guess, it's math. When institutional money must rebalance based on ratio compression, when physical supply faces artificial restrictions, and when futures exchange inventories can't meet delivery demands, prices adjust to ration demand. That adjustment won't be orderly or gradual. It will be violent, sudden, and disproportionately painful for anyone caught on the wrong side of the move. Our job isn't to predict exactly when or how large the gap up occurs. Our job is to recognize that the mechanism is already in motion, and we're running out of time to position accordingly. Let's talk about something that should be making front-page financial news but somehow remains buried in obscure commodity trading reports. Silver is now trading in backwardation, meaning the spot price for immediate delivery exceeds the futures price for delivery months ahead. If you're not a commodity trader, this might sound like meaningless jargon. But let me explain why this matters enormously for anyone with exposure to precious metals or anyone considering buying silver right now. In normal, healthy commodity markets, futures prices trade above spot prices. This makes intuitive sense when you think about it. If you want wheat delivered 6 months from now instead of today, you should pay a premium to compensate the farmer for storage costs, insurance, and the time value of money. This pricing structure, called contango, represents the natural state of commodity markets. When this relationship inverts and spot prices exceed futures prices, you're witnessing a market screaming that physical material is scarce right now, and traders would rather have metal today than promises for metal tomorrow. Think about what this means in practical terms for institutional buyers managing pension funds or endowment portfolios. Imagine you manage $500 million in commodities exposure for a state pension fund, and you've been holding silver futures contracts because they're convenient, liquid, and don't require paying for vault storage. Suddenly, you notice that buying physical silver for immediate delivery costs more than your futures contracts for delivery 3 months ahead. That price inversion tells you something critical. The paper market and the physical market are beginning to separate. And if you wait for your futures contracts to mature, you might discover there's no physical metal available to claim at those promised prices. According to trading data from the London Bullion Market Association and Shanghai Gold Exchange, physical silver premiums in Shanghai hit 15% above London spot prices during multiple trading sessions in November and December. That's not a typo. The same ounce of silver traded for 15% more in China than in England, despite both markets being connected by modern communications and global shipping. This kind of geographic arbitrage gap shouldn't persist for more than minutes in efficient markets, yet we're seeing sustained premiums lasting hours and sometimes full trading days. The only explanation that makes sense: physical metal in Chinese markets has become genuinely scarce relative to paper claims trading in Western markets. Now let's connect this to those Federal Reserve operations I mentioned earlier. The $40 billion in reserve management purchases, plus expanded year-end repo operations. The Fed's official narrative focuses on seasonal liquidity needs and maintaining smooth Treasury market functioning. But here's what catches my attention as someone who spent years analyzing central bank operations. The specific timing and the specific counterparties accessing these facilities tell a different story than the one being publicly discussed. Between December 18th and December 34th, the Federal Reserve Bank of New York conducted reserve management purchases across multiple Treasury securities, with unusual concentration in operations during the final week of the year. According to publicly available data from the New York Fed's website, these operations involved primary dealers, the elite group of financial institutions authorized to trade directly with the Fed. Several of these primary dealers, including JP Chase, Goldman Sachs, and HSBC, maintain significant positions in precious metals derivatives and are major participants in COMEX silver futures markets. Here's the question we should be asking. Why would the Fed need to inject $40 billion in emergency liquidity during a period when banking reserves already exceed regulatory requirements by comfortable margins? The official explanation about year-end balance sheet demands doesn't quite add up when you look at the actual reserve positions these banks maintained throughout December. What makes more sense, given everything else happening simultaneously in silver markets, is that certain financial institutions faced derivative exposure stress, not from Treasury positions, but from commodity short positions, experiencing unexpected delivery demands. Let me walk you through how this derivative stress actually works in practice. When a bank sells silver futures contracts short, they're promising to deliver physical metal at a specified price on a specified date. As long as most contract holders simply roll their positions forward or cash settle without demanding delivery, this system works smoothly with minimal capital requirements. But when large numbers of contract holders suddenly demand physical delivery, as we've seen with those 47.6 million ounces leaving COMEX vaults, banks must either deliver actual metal or buy back their short positions at whatever price necessary to close out the obligations. If you're a bank sitting on thousands of short contracts and suddenly facing delivery demands you didn't anticipate, you have two unpleasant options. Option one: scramble to locate physical silver to deliver, which means paying current spot prices that may have risen significantly above the price at which you sold the original contract. Option two: buy back your short positions at a loss before delivery dates arrive, which creates buying pressure that pushes prices even higher. Either way, you're looking at potential losses that expand the longer physical tightness persists. This is exactly the scenario where banks would quietly approach the Fed for liquidity support while maintaining public statements that everything is fine. Now, let's shift to the demand side of this equation, because even if COMEX vaults were completely full and Chinese exports were flowing freely, we'd still face a structural deficit problem that most investors don't fully understand yet. Industrial demand for silver is exploding across three sectors that are critical to America's technological future: artificial intelligence infrastructure, renewable energy, and electric vehicle production. These aren't speculative or distant demands. They're happening right now, with purchase orders and supply contracts being signed for delivery throughout 2025 and 2026. Start with AI data centers, which have become essential infrastructure for everything from ChatGPT to Google, search algorithms to Microsoft's cloud services. According to Goldman Sachs' Infrastructure Research Division, global data center electricity consumption will grow 160% by 2030, requiring massive expansion of physical computing facilities. Here's what that means for silver. Every server rack, every cooling system, every backup power supply uses silver-based contacts and conductive materials, because silver has the highest electrical conductivity of any metal. A single large-scale AI training facility requires approximately 1,800 pounds of silver just for electrical infrastructure. That's roughly 24,000 ounces per facility. And we're not building one facility. According to industry data, over 100 major data center projects broke ground in 2024 across North America alone. Then there's solar energy, where recent technological advances have dramatically increased silver consumption per panel. The solar industry traditionally used roughly 20 milligrams of silver per watt of panel capacity. But new TOPCon technology, tunnel oxide passivated contact cells, which offer higher efficiency and better performance, requires approximately 30 milligrams per watt, representing a 50% increase in silver intensity. According to the International Energy Agency, global solar installations are projected to reach 500 gigawatts annually by 2026. Let us do that math together. 400 gigawatts equals 400 billion watts, multiplied by 30 milligrams per watt, divided by 103 grams per troy ounce equals roughly 385 million ounces of silver needed just for solar panels in a single year. That's more silver than the entire global mining industry extracts annually from primary silver mines. Electric vehicle batteries represent the third leg of this industrial demand explosion. While EVs don't use as much silver per unit as solar panels, the sheer volume of vehicle production creates massive aggregate demand. According to Bloomberg NEF's electric vehicle outlook, global EV sales will reach approximately 27 million units in 2026, up from around 14 million in 2023. Each EV uses between 25 and 50 grams of silver in various electrical components, battery management systems, and charging infrastructure. Taking a conservative estimate of 35 grams per vehicle, that's 945,000 kilograms of silver, or roughly 30 million ounces annually just for automotive applications. Add in the charging station infrastructure being built across America, which uses silver-plated contacts for fast charging connectors, and you're looking at another 10-15 million ounces of annual demand. Now here's where the supply side of this equation becomes genuinely concerning for anyone hoping mining production will simply ramp up to meet demand. According to the Silver Institute's World Silver Survey, global mine production in 2023 totaled approximately 830 million ounces. That sounds like a large number until you realize that industrial demand alone consumed roughly 550 million ounces, with jewelry, silverware, and investment demand consuming the rest, creating a deficit that had to be filled from above-ground stocks. And here's the critical constraint. Roughly 70% of silver comes as a byproduct of copper, lead, and zinc mining. You can't just mine more silver without mining more of these base metals, and base metal production responds to base metal prices, not silver prices. Think about what this means for the next decade of supply-demand balance. Even if silver prices doubled or tripled, mining companies couldn't significantly increase primary silver output without first justifying new copper or zinc mines based on copper and zinc economics. According to S&P Global Market Intelligence, the average timeline from discovery to production for a new base metal mine runs 10-15 years when you factor in permitting, financing, construction, and ramp-up. We're already locked into the supply trajectory for the next decade, based on projects that were approved years ago. Meanwhile, demand from AI, solar, and EVs is accelerating on a 2 to 3 year timeline driven by climate commitments, infrastructure investments, and technology adoption curves. Major industrial consumers understand this supply constraint and are acting accordingly. According to supply chain reports from solar manufacturers, companies are securing 12-18-month forward contracts for silver paste, the silver-containing material used in solar panels, at prices significantly above spot, essentially accepting higher costs today to guarantee supply tomorrow. Similarly, automotive suppliers are negotiating multi-year agreements with refiners to lock in silver allocations, even if it means paying premiums over market prices. When the companies that actually use silver in production are willing to pay above market rates to secure future supply, that tells you everything about where they think prices are heading. We can also look at what mining executives themselves are saying about the supply situation. At the Denver Gold Forum in September 2024, CEOs from First Majestic Silver and Hecla Mining both discussed the difficulty of expanding production despite rising prices, citing labor shortages, permitting delays, and declining ore grades at existing operations. According to their presentations, even with silver prices at $30 per ounce, which many consider highly profitable, they're struggling to maintain current production levels, let alone increase output. If the industry can't grow production at $30, what happens when industrial demand requires them to produce 20% more silver at any price? This is the reality that institutional buyers drained those 47.6 million ounces from COMEX to avoid. They've run the same calculations we just walked through. They've seen the backwardation. They've noticed the Shanghai premiums. They've read the industrial demand forecasts. and they've concluded that owning paper claims to silver that might not exist in deliverable form is a risk they're no longer willing to take. The question for everyone else is simple. Do you wait until the price gap becomes obvious to everyone, or do you position now while physical metal is still available near paper prices? Let us do some math that should concern anyone managing retirement savings or anyone who thinks current silver prices reflect actual market conditions. Global pension assets under management total approximately $30 trillion, according to Thinking Ahead. Institute's most recent survey. That's $30,000 billion managed by pension funds, endowments, sovereign wealth funds, and institutional asset managers who follow systematic rebalancing rules based on quantitative signals like the gold-silver ratio we discussed earlier. Now, here's the calculation that matters. If just 0.1% of that global pension capital decides to rebalance into silver based on ratio compression below 60, we're talking about $30 billion of institutional buying, hitting a market with total annual supply worth roughly $25–30 billion at current prices. Think about that proportion for a moment. We'd be seeing buying demand equal to an entire year's worth of global silver production, except this demand would hit over the course of weeks or months, not spread across 12 months. The silver market simply cannot absorb that kind of institutional flow at current price levels without dramatic repricing. But wait, you might be thinking, couldn't new supply come online to meet this demand? Couldn't mining companies ramp up production or refiners increase output? Remember what we discussed about supply constraints. According to data from the U.S. Geological Survey, global refined silver production is essentially fixed in the short term because of that byproduct nature of silver mining. Even if every copper, lead, and zinc mine on Earth operated at maximum capacity tomorrow, you'd only increase silver supply by maybe 3 to 5% annually. Meanwhile, that $30 billion in pension fund rebalancing would represent a 75% increase in investment demand hitting all at once. The market's only adjustment mechanism is price. When demand suddenly exceeds supply by massive margins, prices don't inch higher gradually. They gap up violently until enough industrial users delay projects, enough jewelry manufacturers reduce consumption, and enough investors at higher price points decide to sell. Based on typical commodity market responses to supply-demand imbalances of this magnitude, we're talking about price adjustments of 100% to 300% happening over timeframes measured in weeks, not years. That means silver moving from current levels around $30 to somewhere between $60 and $120 before equilibrium gets reestablished. Now, let's talk about the specific catalyst window that makes the next few weeks absolutely critical for anyone with silver exposure or anyone considering positions. 3 separate events are converging between January 2nd and January 6th, 2025, creating what commodity traders call a triple catalyst scenario. First, January 2nd marks the start of a new quarter, which triggers automatic rebalancing for pension funds and endowments that adjust their portfolios every 90 days. These aren't discretionary trades based on opinions. They're mechanical allocations that must happen based on predetermined rules. Second, China's new export licensing system for silver becomes active in January, which means the window for unrestricted purchases from the world's largest refining hub closes permanently. According to industry sources familiar with the licensing process, approval timelines could extend 30–60 days for non-strategic buyers, creating immediate supply disruption for spot market participants accustomed to placing orders and receiving metal within days. Some large industrial users have already secured advanced licenses, but smaller buyers and financial institutions will face delays and potential rejections. Third, January is historically the highest delivery month for COMEX silver contracts. According to CME Group's historical data, roughly 25–30% of annual COMEX silver deliveries occur during January, as investors who bought contracts during the previous year make their final decisions about whether to stand for delivery or roll positions forward. In normal years with healthy vault inventories, this seasonal delivery bulge gets absorbed smoothly. But we're entering January with registered inventories already depleted by 60%, meaning the exchange has far less metal available to satisfy delivery demands than during any January in at least a decade. Think about these 3 catalysts hitting simultaneously. Pension funds must rebalance at the exact moment Chinese supply becomes restricted. At the exact moment, COMEX faces maximum delivery pressure with minimum available inventory. If you were designing a stress test to break a commodity futures market, you couldn't engineer a more perfect scenario than what's unfolding between January 2nd and January 6th. Either prices gap up massively to ration demand, or we witness the kind of market failure that forces emergency interventions like increased margin requirements, position limits, or even trading halts. There's actually a 4th catalyst we haven't discussed yet, the potential for cascading liquidations of over-leveraged retail traders. When silver experiences extreme volatility, whether upward or downward, Futures brokers issue margin calls to traders whose positions have moved against them. If silver gaps down sharply in a flash crash before the real move higher, which often happens when large players want to shake out weak hands before accumulating positions, many retail traders get forced to liquidate at the worst possible prices. Then, when the genuine upward move begins, these liquidated traders are sitting on the sidelines, having locked in losses, unable to participate in the recovery. This exact pattern played out in March 2020, when silver dropped from $18 to $12 in a matter of days before rocketing to $29 over the next 5 months. Retail traders who got stopped out at $13 watched the subsequent rally from the sidelines, having lost capital right before the move they'd been anticipating. The lesson here is that violent volatility in either direction during the January catalyst window could be designed to liquidate leveraged positions before the real price discovery begins. Anyone using leverage or tight stop losses needs to understand they're vulnerable to this kind of engineered shakeout. Let's look at what history tells us about silver's behavior when the gold-silver ratio compresses below 65. We have 3 major precedents in the modern era: 1979, 1980, 2010, 2011, and 2020. In each case, when the ratio dropped below 65, silver outperformed gold by a factor of 3 to 5 times over the subsequent 624 months. Let me walk you through each example so you can see the pattern clearly. In 1979, the gold-silver ratio compressed from around 31 to below 17.1, as silver rocketed from 6 to 49 while gold moved from 200 to 850. That's roughly an 800% gain for silver versus a 425% gain for gold. Silver outperformed by a factor of nearly 2x during the peak phase. More importantly, once the ratio broke below 65 in mid-1979, the explosive phase of the move began, with most of silver's gains compressed into the final 6 months of the rally. In 2010-2011, we saw a similar pattern. The gold-silver ratio broke below 65 in late 2010, dropped to around 46 by April 2011, when silver peaked near $49. During that phase, silver gained approximately 150%, while gold gained roughly 40%, meaning silver outperformed gold by nearly 4/6. Again, notice that the most explosive portion of silver's move occurred after the ratio broke through 65, not before. Most recently, in 2020, the ratio compressed from 125 in March, during the COVID panic, to below 70 by August. Silver moved from roughly $12 to $29 during that period, a 140% gain, while gold moved from $150 to $2,070, a 43% gain. Once again, silver outperformed gold by approximately 3 worse during the ratio compression phase. The pattern repeats consistently. When the ratio breaks below 65, silver enters a phase of outperformance that typically lasts 6 months to 2 years. Now here's what makes our current setup potentially more explosive than any of these historical precedents. In 1979, there was no structural supply deficit. Silver inventories were actually quite large from industrial stockpiles accumulated during prior decades. In 2011, Chinese exports were unrestricted and COMEX vaults were full. In 2020, industrial demand was suppressed by COVID lockdowns, reducing consumption from automotive and manufacturing sectors. None of these historical analogs featured the combination of depleted inventories, restricted supply, exploding industrial demand, and ratio compression below 60 that we're facing right now. According to data from the Bank for International Settlements, the notional value of silver derivatives outstanding across global exchanges totals approximately $40 billion. If physical market stress forces even partial unwinding of these derivative positions through delivery demands, margin increases, or position limit enforcement, the buying pressure required to close out short positions would be enormous relative to available supply. Think about what happens if major short holders need to buy back just 10% of their positions in a physical market already showing signs of scarcity. We'd be looking at price spikes that make historical moves look tame by comparison. So what's a reasonable price target based on this analysis? If we assume silver needs to reach a level that rations industrial demand, satisfies pension fund rebalancing, and compensates for restricted Chinese supply, we can work backward from demand projections. Industrial users currently show willingness to pay 15-20% premiums over spot to secure forward supply. Pension funds rebalancing to a 60.1 ratio with gold at 2,400 implies a silver price of $40, but that assumes no supply constraints. Add in the China export premium and delivery stress, and you're easily looking at $50-$60 to clear immediate demand. But here's where it gets interesting. Once silver breaks convincingly above 50, the psychological level where it peaked in 1980 and 2011, you trigger FOMO buying from retail investors who sat out the initial move momentum algorithms that trade breakouts of multi-decade resistance levels and media attention that brings new capital into the sector. According to positioning data from the CFTC's Commitments of Traders reports, managed money, the category that includes hedge funds and momentum traders, currently holds near record low long positions in silver. That means there's massive dry powder waiting on the sidelines that could chase the market higher once the breakout becomes undeniable. Combining the mathematical demand from pension, rebalancing the supply restrictions from China, the industrial deficit, and the technical breakout dynamics, a target range of $100 or $150 per ounce by Q2 or 2026 is not speculative. It's the logical outcome of forces already in motion. Could prices go even higher? Absolutely, especially if we see genuine shortage conditions where industrial users compete desperately for available supply. Could prices fail to reach these levels? Only if demand collapses, which seems unlikely given binding solar panel contracts and data center construction schedules, or if massive new supply appears, which we know can't happen on relevant timescales. The question every American with retirement savings needs to ask themselves is simple. Do these numbers represent an opportunity or a threat? If you hold physical silver or well-structured positions in silver miners, this setup represents potentially the best risk-reward scenario the precious metals sector has offered in over a decade. If you're planning to buy physical silver for wealth preservation but haven't acted yet, you're watching the final weeks of sub-$35 availability before the January catalyst window potentially reprices the entire market. And if you're completely unaware of these dynamics while holding retirement portfolios allocated to traditional 60-40 stock bond mixes, you're missing both the opportunity and the portfolio insurance that silver exposure could provide during the turbulent rebalancing ahead. This isn't about predicting the future or making lucky guesses. This is about recognizing mathematical certainties playing out in real time. When pension funds must rebalance, they rebalance. When Chinese export controls activate, they activate. When COMEX inventories run low during high delivery months, something breaks. We're not waiting for these catalysts. We're watching them converge right now during the quiet holiday period when most investors are distracted. The professionals emptying those COMEX vaults in December understood the timeline. Now you do too. What you do with this information over the next few weeks will determine whether you benefit from this repricing or watch it happen from the sidelines, wondering why nobody warned you it was coming.